What if the slowest boat in Oroville Bay consistently beat every flashy speedboat over 20 years? Active investing means a professional fund manager handpicks individual stocks, betting that superior research and faster reflexes can outsmart the broader market. It's a high-effort, high-cost strategy built on one belief: that human judgment can consistently identify winners before everyone else does. Passive investing takes the opposite approach. Instead of picking winners, you buy a thin slice of the entire market and hold it. The real-world sailboat in our story is the S&P 500 Index Fund, a single basket holding shares in 500 of America's largest companies at once. When the economy grows, the sailboat rises. No guesswork required. Enter Baron Detmore, Oroville's most theatrical stock picker. His golden speedboat, the Alpha Chaser, runs on expensive engines, a team of analysts, real-time data feeds, and a fee structure that quietly drains your fuel tank. Both boats launch from Oroville Harbor on the same morning with identical cargo, $10,000 each. The destination is Index Fund Island, 20 years across the bay. Same starting capital, same open water, radically different strategies. Year 1, the Alpha Chaser explodes off the dock. Baron Detmore's analysts pile into a hot tech stock, and it doubles. The sailboat barely moves. From the shore, the race looks finished before it starts. But look below the waterline. Every trade the Alpha Chaser makes burns fuel. In the real world, that fuel is called an expense ratio. The average actively managed fund charges roughly 1% annually. The average index fund charges just 0.03%. 1% sounds trivial. Over 20 years on a $10,000 investment, earning 7% annually, that fee gap alone costs you over $15,000 in lost compounding. That's not a rounding error. That's a second boat. Here's where the story gets uncomfortable for Baron Detmore. S&P Global's SPIVA report for 2023 found that over a 15-year period, roughly 92% of large-cap active fund managers underperformed the S&P 500. 92%. The reason is almost philosophical. In 1970, economist Eugene Fama published his efficient market hypothesis, arguing that stock prices already reflect all publicly available information. If everyone knows a company is great, its price already says so. Some managers do beat the market. For a year, even 3. Baron Detmore's speedboat genuinely pulls ahead in calm water. The trap is mistaking luck for skill. Researcher Laurent Barras confirmed in his 2010 Journal of Finance paper, False Discoveries in Mutual Fund Performance, that most outperformance dissolves after adjusting for chance. Here's the leak most passengers never notice: taxes. Every time Baron Detmore's team sells a winning stock to chase the next one, that sale triggers a capital gains tax event. Index funds almost never sell, so they almost never trigger that tax. Meanwhile, the sailboat runs on a beautifully simple engine: compounding. Every dividend reinvested buys more shares. Those shares earn more dividends. At 7% annual growth, the rule of 72 tells you your money doubles in roughly 10.3 years, meaning your $10,000 becomes $20,000 before the race is even halfway finished. $10,000 compounding at 7% annually, a historically reasonable estimate for the S&P 500 after inflation, becomes approximately $38,000 in 20 years. You did nothing except stay on the boat and resist jumping off. The sailboat also survives storms the speedboat can't. Because an index fund owns 500 companies at once, when one collapses, think Enron in 2001, it represents less than 0.5% of your total portfolio. The storm barely rocks you. Here's where it gets genuinely hard. Markets crash. In March 2020, the S&P 500 dropped 34% in 33 days. The sailboat didn't sink, but passengers panicked and jumped. Selling at the bottom is the single most expensive mistake in investing. The antidote is dollar-cost averaging, investing a fixed amount every single month regardless of price. When markets crash, your fixed contribution buys more shares cheaply. When markets rise, you already own those cheaper shares. Crashes become sales, not disasters. Year 10 of the race across Oraval Bay. The Alpha Chaser has zigzagged, chasing every hot sector. Tech, crypto, biotech, burning fuel at every turn. The sailboat has held one straight line. Quietly, without fanfare, it's pulled ahead. Three mechanisms explain the sailboat's lead. First, low fees preserve more capital to compound. That 1% annual difference accounts for over $15,000 of the gap by year 20. Second, broad diversification eliminates catastrophic single-stock risk. Third, the passive structure removes the temptation to trade on emotion, keeping all three advantages intact at once. The sailboat was built by a real person. In 1976, John Bogle launched the first retail index fund through Vanguard. Wall Street mocked it as Bogle's folly. Today, Vanguard manages over $8 trillion. The folly became the foundation of modern personal finance. Bogle's core innovation was structural. By stripping out the fund manager's salary, the research team, and the trading desk, he cut the expense ratio from over 1% to just 0.43% at launch, and eventually to fractions of that over subsequent decades. That's the same leak we spotted in the Alpha Chaser's hull back at the harbor. The most famous real-world test. In 2007, Warren Buffett bet $1 million that a simple S&P 500 index fund would outperform any basket of hedge funds over 10 years. In 2017, Buffett's index fund returned 85.4%. The hedge funds averaged 22%. Buffett's bet involved $1 million, but the math scales down cleanly. An everyday Oraval citizen investing $300 monthly into a broad index fund from age 25 to 65 at 7% average annual return accumulates over $700,000. The most persistent objection. What if you invest right before a crash? Research from Charles Schwab in 2021 examined every possible 20-year window since 1926. Even investors who bought at every single market peak still finished with positive returns. Time in the market beats timing the market. Intellectual honesty demands a caveat. In less efficient markets, active management can show a measurable edge. Morningstar's 2022 Active Passive Barometer found that active funds in diversified emerging markets succeeded at nearly double the rate of their domestic large-cap counterparts. In private equity and illiquid real assets, information gaps stay wide enough for skilled managers to exploit. Practical mechanics matter. A broad market index fund is accessible for any major brokerage: Fidelity, Schwab, Vanguard. Tickers like FZROX, SWTSX, or VTI represent total market funds with near zero expense ratios. Setting up automatic monthly contributions takes under 15 minutes. One more engine upgrade: tax-advantaged accounts. Inside a Roth IRA or a 401k, your index fund compounds without annual capital gains taxes eroding it. The IRS becomes a silent passenger who never collects a ticket. Over decades, that advantage is enormous. Year 20. The Alpha Chaser limps into Index Fund Island's harbor. Engine sputtering, fuel tanks drained by fees, hull scarred by panic sell storms. The sailboat docked 3 years earlier. The $10,000 cargo has grown to $38,000. The speedboat carries $23,000. That $15,000 gap isn't abstract. According to the College Board's 2023 data, the average annual in-state tuition at a public four-year university is $11,260, meaning the sailboat's advantage covers a full year of college and then some. It's also a reliable used car or a down payment contribution on a home. The boring boat's advantage is denominated in real life, not spreadsheet cells. Remember the question from the harbor? What if the slowest boat consistently beat every flashy speedboat? The answer isn't luck or magic. It's math. Low fees, broad diversification, relentless compounding, and the discipline to stay on board through every storm. Here's the number that reframes everything. The Investment Company Institute estimated that Americans paid roughly $68 billion in mutual fund fees in a single year. That's not one investor's Alpha Chaser draining fuel. That's an entire fleet of speedboats siphoning wealth from millions of passengers at once, year after year. whether the market rises or falls. Your single actionable takeaway: open a Roth IRA today. Buy a total market index fund with the lowest available expense ratio. Set an automatic monthly contribution you won't miss. Then let 20 years of compounding do the work Baron Detmore's entire fleet never could.